From where you sit, when you look at the lending, the role that banks have to play in lending to REITs, and the alternate sources of financing that are available to REITs, what do you see as the role that you play, as the banks play, specifically for REITs? And I don't know if you have experienced lending to REITs in the South African market. I think the one distinction you would have with our market is that here REITs are unincorporated. So they're unincorporated, what we call like chamas, it's an unincorporated entity. But aside from that, I think your dynamics when it comes to lending to REITs there and here would be very similar. So what role do you see banks playing in this particular sector?
Thanks. Thanks, Farhan, for the question. Hello. Can you hear me? Yeah. Hi, guys. My name is Mncedisi Dumse. I'm from Stanbic Bank Group.
Sorry. Just take there that it keeps going in. Biko.
Go on. Yeah.
Hi, can you hear me? Okay, that's perfect. So my name is Mncedisi Dumse. I'm from Stanbic Bank Group. So in terms of the role that financial institutions can play in REITs, as my colleagues mentioned, I mean, REITs require capital. And as a financial institution, we provide debt capital, and we provide various types of debt capital, from term loans to revolving credit facilities. And from a support perspective, the reason why you provide different type of funding structures is it's all subject to what the REIT requires, right? So if it's a D-REIT, we have development facilities. If it's an I-REIT, you put a term loan in it. You can tailor your structure so that you don't pay any capital back, so that there's enough cash flow for distributions. Sometimes the purpose of the revolving credit facility is also there to help manage timing issues, to manage obligations, or to pay for certain costs or whatever short-term cash flow support that a REIT might need. That's the benefit that the financial sectors can provide, financial institutions can provide to REITs. The pros of getting debt sometimes is that it helps you scale your business in terms of investing in a number of opportunities, but for every pro, there's sometimes cons. Sometimes debt can also come in with restrictions on covenants and the ability to obviously to incur other debt unless if you met certain performance criteria. So debt has a place to play to help you scale up the business, help it stabilize, and help with flexible cash flow structures, depending on the purpose of the funding. To your point, I've been involved in some South African transactions, even some in Botswana, and we've done that to help a lot of the developers manage even maturity profiles, right? Because they would say, look, we can't have our entire capital stack expiring from a debt perspective at a single point in time. So you would then structure it according to what their maturity profile needs to look like, again with the with the different instruments within the debt structure, so that it supports their growth, but as well as also obviously give them sufficient room to be able to pay out distributions.
Lydia, if I can throw a question to you just arising from what Dumse has said. Is there a difference between lending to a property fund or lending to a company as opposed to lending to a REIT? And so are you in essence, as it were, in a better position if you understand how REITs operate vis-a-vis just traditional lending? Or is it, when it comes to lending, is it the same? I think he mentioned something, and specifically the key things I want you to comment on is Dumse talked about the repayment to allow the REIT to have capital. So whether it's your bullet payments, whether it's the gearing that Mathew had mentioned, whether it's what avenues you have when there's default, is it the same when you're lending to a REIT as opposed to when you're lending to a property fund?
So there are some basics that don't change regardless of who you're lending to. And number one, what banks will look at is your capacity to repay. Because what we tend to say is that security, because people tend to think that we are more concerned with the security, that we have to have charge over the title. That is actually not the case. So regardless of whether it's a REIT or a property fund, some fundamentals remain. However, now the distinction comes in terms of the governance around the REIT possibly makes it a bit better and easier to lend to, which is why you've been seeing a lot of appetite from various financial institutions because they are sort of assured there will be no diversion risk, and they are also monitored, and there's very clear transparency because of those reporting obligations and the fact that it's a regulated entity and that there are various governance structures within it. So the fundamentals of lending remain, but now lending to REITs is becoming a bit more attractive, and financial institutions are looking to lend to an entity. And we've seen in the market, there are those entities which banks went and lent to during all this real estate boom, and some things didn't turn out according to what had been projected, but now you're dealing with professionals in a REIT. So they actually are making projections and can be held to account, and the expectation is that REITs are not going to be the ones contributing to this non-performing loan scenario that you've seen a lot in the banking sector. So I think that's how I would say the differences between lending to any property fund and lending to a REIT is structured.
Thank you, Lydia. That's a very interesting point. Very true. When you look at the property funds, you look at there's been a number of defaults that have happened in the recent past. But I think when it comes to REITs, as of yet, we're still yet to see if at all we will ever have a default in that scale. Mathew, there's something that Biko had mentioned that I wanted you to touch on. He mentioned the effect of the interest rates. From where you sit, how has the fluctuation of the interest rates that we saw recently, how that affected your access to capital, but also the avenues with which you go to seek financing?
Loaded question. So let's talk about how interest rates affect a REIT. So let's talk a day REIT. So you have a project, you're funding in a REIT, you're capping debt in the project at 65%. You go into the market, you issue a green bond, 12.5%, 5-year period, fix your cost. If it's floating, if you go to the market and issue, and if it's not a capital market instrument, and go and issue and buy and take a conventional bank debt, the pricing of debt in the bank is purely on the cost of money, as she said. You can have a beautiful story, at the end of the day they look at their cost of money. If it's floating, you took that debt in 2019, in 2022, you're sitting at 21, 22% on collateralized debt. It means your cost of debt in the portfolio has gone up 10%. That means your project budget just increased on debt. On an IREIT, you do the same. IREIT, your yields are sitting at 8%, cap, maybe appreciation, maybe about 5%. So total return 11, 12. You're going to borrow short term, and that's why you have to do a term loan. I believe just do nothing more than 2 years. At best 12 months if you can repay, because then you have visibility of what's going down in terms of rates. In an IREIT, if in the same scenario you went to borrow at 12%, it means you're actually borrowing at yield. Your cost of credit moves from 12 to 22%. It means my distributions, which I'm supposed to pay back to my investors, I'm working for the bank. Because there's nothing I'm doing. I'm seeing I borrowed, my cost of debt in the IREIT was 100 million a year. 5 years down the line, that cost is 400 million. So it means I'm sweating my equity, I'm sweating my properties, I'm doing rental escalations to manage that, because that's one way to manage your debt and manage your OPEX margin. But debt alone in those two scenarios already is limiting you. IREITs, highly sensitive to debt, very dilutive. Now, what sort of strategies would you employ? First is, if you can get fixed term debt, 3-5 years, manage that, and investors accept that, good. Second thing is, what we're seeing increasingly is that other than conventional bonds like we did, or green bonds, or even a typical bond. Commercial papers are fairly good. In an environment today, I think this month, for the first time in 12 months, the T-bill rate dropped below 15%. That means your average pricing of debt that banks use is on a 182-day rolling basis. So if you go to the market today and issue a 12-month 365 commercial paper, you'll be sitting at maybe 15, 15.7. If you offer 16.5 over 1 year, keep it fixed, floating if you reprice, what you see is instead of having long-term debt that eats into your yield, you are able to reprice as rates keep coming down. Therefore, you release some distributions back to the investors. The second thing is, and we're seeing banks do this, is they want to protect their downside. So what they come in to say, we know you're more focused on the upside because you don't want debt to move from 12.5 to 22 or 23. It completely wipes out your equity. If you're a promoter of a new REIT, you will keep pumping in money and it will not stop. So the way you do it is they put a cap and say, my long-term lending rates over the last 10 years has been maybe 12%, so I'll cap it at 12. And then I'll put a ceiling of maybe 16.5 and match it to a 1 year 365-day paper, and that you're sitting at 16.5. If you collateralize it, then you drop it to 16, then you are playing within that level. That means if your project is delivering yield on cost of maybe 14.5, IRRs north of 35%, you can meet your cost of debt in a D-REIT. So you have to balance both and see which makes sense. Debt in the D-REIT, leverage as much as you can.
Thanks.
Debt in the I-REIT, cap it.
Thank you, Mathew. I'm being told we just have 5 minutes, so I'll just do one more question. On the same Biko, from where you sit, other than what Mathew has mentioned, what strategies do you think REITs can use to have a sustainable growth? Because from what Mathew has said, it's almost rather bleak. So how do you plan for sustainable growth with your financing?
Well, there are quite a number of challenges within the environment, and I would say those who are issuing or structuring real estate products, REITs in particular in this discussion, have got a lot to grapple with. So we have to step back and look at the wider picture. You have to look at the regulatory environment. You have to look at the kind of economic cycle we are in, so that we figure out how we can influence policy just to enable this particular space grow. And of course, we have to commend the regulators. There's quite a bit of work that has been done. So a lot of transparency pointing towards governance issues that will give investors assurance in terms of the kind of investments they're making is very critical. When it comes to the funding side, looking at the capital structure versus optimally delivering for the REITs to the investors. Of course, at the end of the day, some innovation around how to tap into financing is important. So you talked about green financing, for example. If there's any kinds of concessions that can continually come in that space. And I liked what Mary from FSD earlier was talking about, focusing on those spaces, then those could continue to be useful. A good question was asked to our speaker, Mr. Tahiri here, on what is making the Moroccan market perform so well. And yet Kenya and Ghana are still at the 3-4 in number of REITs. I think one has to look at the sort of environments we are operating in from a policy perspective and economic growth and stability. I think those are critical. And maybe therein we'll find some answers. There's no easy way out. So if Mathew was to come to us for funding, I will gladly tell him that my esteemed investors who have entrusted us with the funds are looking for a certain kind of return, and therefore, if they're able to meet those levels, then yeah, we have something to talk about.
Thank you, Biko. Thank you very much.
Thank you. I know we're talking about financing, so I know there are questions, for sure. I'm not letting you out. I'm not letting you into the next session without at least one question. Where is Agnes? Because I know she has one. Agnes, Aggie. Okay, got you tings. All right, go for it.
Hi, my name is Kelvin from Liaison Group. So my question is to Steve Biko. I'd be interested in understanding or clarifying, does it mean that returns take higher precedence in relation to concentration risk? Because it seems like fund managers are willing to overweight the portfolios into one asset class to result in a higher return instead of considering the entire risks associated with each of these asset classes as well.
Your boss is here. They should be very proud. All right, let's go. Who's tackling that? Biko.
Thank you for the question. Well, like I said, it's not one or the other. We are looking at all those elements within a portfolio. So one would ask, would you rather look at securities that would be deemed risk-free in an environment versus those which will carry some element of market risk over and above in terms of making a choice to invest? So the first point of call will be the risk-free investments and the kind of return they'll give you. And then we will look at concentration risk, okay? So I hope I'm answering your question. And concentration risk doesn't just come in piling up funds in government securities. And the world over, if you look at the size of bond markets versus REIT markets, then that could point you towards an answer. We are also looking at, if you're looking at REITs, the kind of concentration they would carry within themselves. And that also goes to speak to what was pointed out earlier in the Ghana situation. Initially, people were going for bond investments, and then later they would come to the REITs. Now, I'm thinking in any market, when the bond market collapses and largely public debt issued, then there are so many other things going on within that economy, and any investor would have to ask for an arm and a leg for a return in any other risk-bearing asset. So maybe that is something worth considering.
Thank you. A round of applause, please. Now there's like 17. Penina, you know I can't ignore you. That's just harsh. Okay, but short, sharp answers, please. Penina.
Yeah, just my question goes to Mathew. Mathew, you said there are several ways of funding REITs. And one of them you mentioned just in passing, JV, but you said you want to touch on that. Kindly, let me just understand why you didn't want to touch on the JV.
In 2 sentences.
Because we did.
It's working. Just believe it's working, then it'll work. Oh, Lord.
Can you hear me?
We need funding for
Okay.
microphones.
So we have our portfolio in the REIT is about 9 operating assets. In one of those properties, it was a nightmare, especially if you're transitioning a property into a fund. Typically, JVs, trust you me, midway, one of the parties will change what they wanted to do with the money, and they'll come and ask for the money. The money is in brick and mortar. So typically you find that unless all of you guys are aligned, that this is your exit strategy that we'll develop together, and then you will get units in the REIT, and then you can go to a secondary market and exit that way, or hold for a period of time, benefit from dividends, then sell your units, typically unless you have that upfront arrangement. We don't do JVs. We feel that it's most efficient for REITs to go and acquire assets. Raphael showed you about location and visibility. So you want to get good quality assets, because good quality assets drive up occupancy. You get fantastic rental revenue. You can escalate rent. But in a JV, to do that, I mean, sometimes it's very difficult because one party or the other just pulls out and your project stops.
Perfect. Last question.
Sorry, Brian, this will be quick. Coming from the pension industry, I want to ask, since morning we've been having the citation or the quote that the pension industry is not picking up rates as you all expected it to do. But my question is to the three of you, as a pensioner or as a trustee, a bank is my custodian, a bank is my fund manager, and right now a bank is a trustee for most of the rates. Where does that leave me? If that is to go down, where does that leave me? That is one. Two, how are you prepared? Because right now every pension industry or every pensioner out there or trustee is worried about the government bonds and how they're performing. So how much are you prepared to be the alternative, and how are you prepared, especially for pension schemes, with the millennial problem of people who are quitting day and night? How prepared are you to be easily changing with the need for money in the pension industry? Because that is going to come. If you're coming up as the alternative to the government bonds, that is going to come. How prepared are you, and what can be done about it?
In 2 sentences each. You're allowed. I'll allow.
Allow me just to go very fast. The pension funds management sector is very well structured, with roles very clearly defined, with very strict regulation. And that's why that sector has grown from 1997 to date. We are talking about 1.7 trillion in terms of assets, with very minimal leakages or any funds lost. There's a reason for that. Then the second bit, to say that we are concentrated in government securities doesn't mean that we're not looking at alternative investments and that we're not looking at property. We're just quickly defining the kind of risks we'd be contending with and then making decisions as to whether that's the best place to be. So of course, we're always tracking to see whether the space is ready. And we are looking at alternative spaces.
Next.
I'll speak about my past life. With Biko, we used to fight a lot, structuring the IPS. So the investment policy is structured very well. And the Gen Z story is catered for by portfolio structuring, which is a typical straight theory in fund management. But in terms of the pension fund industry, the cardinal rule number 1 is capital preservation. I'll give you money, just don't lose it, you give it back to me. And now, when I fundraise through Biko and many others, it's bottom line upfront. What's my return comparative to where I would put money? So they will diversify for sustainability, for impact, for beautiful story, but at the end of the day, it must also have some component of return. So at the end of the day, that member wants, you give you a shilling, they want a shilling and 20 cents back, 2 shillings. So they have to protect that. And so portfolio structuring, asset liability matching will take care of the Gen Zs in the funds.
And to give you the assurance in terms of the separation of powers, the REIT manager and promoter cannot be related to the trustee. So that in itself ensures that when I sit with Mathew or with any other of the REIT managers, I'm able to ask any of the tough questions that an investor would need to ask and is not on the table with no fear or favor, because the trustee is looking after the interests of the investors. Then the other safeguard that you have, as you have the banks as trustee, is that first of all, being well-capitalized entities, we have our own name to protect. We do not even want to be associated. There are REITs, I can tell you for free, we've told not interested. You are going to associate us with a bit of things that we do not want. But more importantly, is the kind of separation that is there, that REIT assets do not form part of the balance sheet of the bank. So you are assured that the assets of the REIT are very separate from the business of the bank in terms of it being a deposit collector and lender and such other businesses, transactional business that the bank does. So we are able to separate ourselves and provide a service to the REIT, and also where we are overseeing, there is that separation that the REIT manager cannot be related to the trustee, and it's entrenched in the regulations.